Good evening. Thanks for joining tonight's webinar, How to Minimize Taxes Under President Biden's Proposed Tax Plan. Now that our election cycle is finally done, with this one made a bit longer by the Georgia runoff elections, we know that the Democrats won the White House, the House, and the tiniest of majorities in the Senate. So the likelihood of passage of some of the plans that candidate Biden proposed on the campaign trail has increased by quite a bit, and it's time to take a look at what he proposed, share some thoughts on the likelihood of passage, review some tax savings ideas in general, and share some specific planning items to help you minimize taxes going forward. For those of you who don't know me, my name is Sammy Azuz. I'm the president of Heritage Financial Services, and I've been a wealth manager for over 20 years. I'm also the author of a personal finance book, Beyond the Basics, Maximizing, Allocating, and Protecting Your Capital, and the Boston Advisor blog. Heritage Financial is a 35-person wealth management firm that helps people who are serious about their finances build smart, cost-effective portfolios paired with detailed financial planning. We're currently celebrating our 25th anniversary, manage $1.7 billion for high net worth clients, and have been fortunate enough to receive some great recognition as a top investment advisor from the likes of Barron's, Forbes, and Financial Times. Today's webinar will cover President Biden's proposals and thoughts on implementation and retroactivity before transitioning to a tax savings framework and some tax savings ideas. And then we'll wrap up with questions that you can ask me through the Zoom private chat feature and get you all off your computers before 7 o'clock. So let's dive right in. President Biden proposed a range of proposals that we're sharing here on this slide. I've organized them kind of from left to right based on what I think are minor or major overhauls or tweaks. So as we go through them, the first one is increasing the top income tax rate from 37% to 39.6% for taxable income over $400,000. Similarly, reducing the impact of itemized deductions or capping them at 28% for people making over $400,000, which is otherwise known as the PEAS limitation. Third, increasing the corporate tax rate from 21% to 28%. No details yet on this, but a likely phase out above $400,000 for the Section 198 tax deduction. Increasing the Social Security payroll tax to have it hit earnings over $400,000 to bolster Social Security. Changing the estate and gift tax exemption amount, bringing it from the current levels back to where it was in 2009, which would be $3.5 million per person and a top federal tax rate of 45%. Taxing long-term capital gains and qualified dividends for those making over $1 million at the top income tax rate, and eliminating the step-up in cost basis at death. I've organized them here based on how minor or major of a change I think they are for individuals. It's a bit subjective on my part, but I think directionally at least it makes sense. Things on the left we've seen before in the tax code and recently. Things on the right are bigger adjustments. So as you think about the likelihood of implementation, I look at things on the left as being much more likely than things on the right. The Senate is barely in Democrat hands. It's been called a blue ripple, not as much of a wave. And for now, the filibuster remains intact. And at least 2 Democrat senators have pledged that they will not vote to undo the filibuster. Legislation can pass by majority vote through reconciliation, but that option does have limits. I think it's capped at once a year in terms of when you can utilize it. Therefore, big disruptive tax changes like the eliminating the step up in basis at death and doubling the capital gains tax for wealthy individuals may be harder to pass. Additionally, the consensus seems to be that tax changes, if they happen, might wait until next year, given that stimulus legislation is a higher priority. Raising taxes before the economy fully recovers may challenge that recovery. And it's not clear that all Senate Democrats are on board with tax increases. And then finally, a quick note on retroactivity. People worry about the tax bill passing and then being kind of put back to prior days. Retroactivity, the odds of it are small, but not zero. So of the 6 major tax increases that we've had since 1980, only the 1993 one was retroactive. It was passed in August, but went into effect as of Jan 1 that year. With that said, let's get down to a framework to help you minimize some of these taxes. Lots of these being things I think make sense regardless of whether the things on this slide pass, but this is a framework that you can utilize that I put into 3 parts. First is something I call do no harm. And just a bit of a heads up on this section, it's difficult without diving into your personal situation or understanding your depth of knowledge on this topic to come up with suggestions that will work for everyone. But what I can tell you is that all of these ideas or issues are things that we have consistently seen our clients benefit from. So doing no harm. At the risk of oversimplifying, our tax system taxes realized income, not increases in net worth. The ideas on this slide are designed to help you minimize realized income and maximize unrealized income so your gains in wealth are not taxed as much. How do you do that? So one here on the left, you can't minimize realized income if you constantly need money to fund your spending needs. To spend a lot, you have to do one of 2 things: consistently realize income or constantly sell investments and realize gains to fund your lifestyle. 2, the second way to do no harm is avoiding short-term capital gains in your portfolio. Realizing short-term capital gains is extremely inefficient and will be more so with higher tax rates. To avoid realizing short-term gains, hold on to your investments for at least a year. And then related to this, number 3, beyond this 1-year holding period, in general, you can avoid further tax harm by having a low turnover portfolio so you're holding on to your investments for longer. Frequent trading in your portfolio causes realized gains, which causes taxes to be paid. Long-term investors should make fewer trades, keep their gains unrealized, pay less in taxes, all of which leads to more capital being compounded since you're not losing a chunk of it to taxes every year. An example of this on this page here, slide 8. This is a hypothetical $100,000 portfolio growing over 20 years at 9% with a 20% long-term capital gains rate. Turnover rates are here, final portfolio value here. And as you see, the lower the turnover rate, the higher the terminal amount in the portfolio. So, whether you hire a money manager, manage your portfolio yourself with mutual funds or ETFs, you have the ability to look at the turnover statistics of your portfolio and try to focus a portfolio turnover somewhere here. There's no reason why you should be trading stocks or your mutual funds or ETFs are trading stocks and holding on to them for less than 2 to 4 years. The other thing you can do kind of related to doing no harm is to use your retirement and taxable accounts well for asset location purposes. Sheltering less tax efficient investments in tax deferred retirement accounts and more tax efficient investments in tax efficient brokerage accounts. You just want to factor in the gross return expectations of those investments and not just the tax treatment. But this slide has a general ranking of where investments fall on the tax efficient landscape. So taxable bonds, high yield bonds, REITs, considered less tax efficient, most tax efficient, obviously municipal bonds, but even stocks in a low turnover strategy and everything in between. Now shifting gears a little bit to specific tax strategies. The other thing that you can do is to make sure that you are hitting and making all of your retirement plan contributions. So if you're an employee, make sure you're taking advantage of your full deferral limits, including catch-up contributions. For employers, make sure you're taking advantage of retirement plan design opportunities and selecting the right retirement plan to shelter as much of your taxable income as possible. I consistently see employers leave way too much tax savings on the table here. Get rid of your simple IRAs, probably get rid of your SEP IRAs, a 401k with a plan design that allows you to max out through profit sharing contributions to that $64,500 level if you're over 50 or 50 or over, with a funding ratio that is skewed in your favor. And that's just the start. You can also use cash balance plans or pension plans to shelter so much more. So for now, just don't assume that as a business owner that's setting up that type of plan with the right design will be too costly or require too many contributions or more contributions than you'd like to make for your employees, you might be pleasantly surprised. And this is the easiest thing that you can do to shelter income from higher tax rates. Next, I'm going to hit this one quick, but you can invest in a health savings account if you're enrolled in a high deductible healthcare plan. Contributions are going to be tax deductible, including from FICA, which retirement contributions are not. They're going to grow tax deferred, and they're going to be withdrawn tax free. So it's definitely an underutilized way to save on taxes and grow a healthcare nest egg. More tax planning opportunities over the next few slides deal with charitable giving. Just basically giving to charity more effectively. The first is bunching your charitable contributions, which I'll go over as an example here on the next two slides. So you have a couples married filing jointly. In 2021, they have a mortgage interest deduction of $9,000. Their state and local property tax deduction is capped at $10,000 because of the tax cut that passed a couple of years ago, and they're going to give to charity in the amount of $30,000. So their total itemized deductions for the year are $49,000. So they're going to itemize. They're not going to take the lower standard deduction. And they're going to do that same thing for 2022, 23, and 24. So in aggregate, over those 4 years, they're making a $120,000 charitable contribution and having total itemized deductions of $196,000. If instead of doing this, they bunch their charitable contributions initially, and this is just a hypothetical, it's an example, but you can work with your CPA and your planner to see if you would benefit from something like this given the higher standard deduction. So this is what they do instead. In 2021, mortgage interest of $9,000, SALT deduction, again, same of $10,000, but they contribute all of their 4-year charitable contributions in 2021. Maybe it's to a donor advised fund, they get it all in there. Their itemized deductions that year are $139,000. Then 2022, 23, 24, they still have the mortgage interest, they still have the state and local tax deduction, but they've done their charitable giving. Their itemized deductions are only 19. So now they're going to be taking the standard deduction for those 3 years. And because of that, their 4-year total deduction will be $18,300 more. The second way to improve the charitable contribution is doing more than just giving cash. Here's an example of how donating appreciated securities could be more beneficial than, again, a straight out cash contribution. It's based around a $50,000 charitable contribution. So option one, you give $50,000 to charity, you're in the 24% tax bracket, you get a $12,000 tax deduction. Option two, you have a stock, it's gone up, let's say 70%, you give it away, it's worth $50,000. Instead of paying capital gains taxes on the gains and your tax rate's 15%, so I was assuming a $5,250 capital gains tax that you avoid because you gave the stock to the charity, they turn around and sold it. You get that tax savings plus the deduction over here of $12,000. So instead of $12,000 in tax savings, you're getting $17,250 tax savings. And then finally with charity, make sure you're taking advantage of the qualified charitable distributions from your IRAs. So you're allowed to gift up to $100,000 from an IRA directly to 501c3 charities. You must be over the age of 70 and a half at the time of that QCD, even though the required minimum distribution age has increased to 72. You can still do this at 70 and a half. The distribution does not count as income. You don't get a charitable deduction for it, but it does not count as income. And in 8 years, when you're 72 or over, it counts towards satisfying the RMD for that year. And this strategy may have the added benefit of reducing AGI, which could result in lower Medicare premiums depending on your overall income. Then the third part of this framework is looking at the estate tax. It's been a while since a lot of people have had to worry about the estate tax. Here's where the estate tax limits stand now. As a reminder, Biden's plan would lower the exemption amount to $3.5 million and raise the tax to 45%. And you can see here we're at over 11 million for each and a 40% tax bracket. What to do? A deep dive into all of these ideas is beyond the 25 minutes we have here and probably beyond your interest level. But I like to think of estate planning with this framework. One, if you have assets, you have to have the things listed in level one right here. These things, plus the basic trusts that are set up to allow you to shelter your state and federal exemption amount when you die, are key. Very little downside, and there's no real lack of control over your assets with this stuff. Level 2, some people need to hit. Further estate planning that generally involves some loss of control over your assets, but generates good estate tax savings. Things like structured charitable giving and gifting assets to family over time through trust to take advantage of discounting rules. Level 3, we haven't seen this stuff in a while with the higher exemption amount, but they may be back in vogue and would likely be discussed during a level 2 conversation. Things like family limited partnerships, offshore trusts, LLCs. I think you'll want to build a financial plan to understand the impact to yourself from some of these strategies. Work with an estate planning specialist and involve your CPA as well to see what the overall financial and tax benefit to you is of doing some of these things. And with that, I'm happy to turn to Q&A. I've received some questions through the chat. And as I mentioned, if you do have questions, please let me know and I'd be happy to address them and still kind of get you out of here on time. And right now I'll start and try to get through as many of them as I can. The first one is there any talk of reducing or undoing the SALT adjustment? So a couple of years ago, with the tax cut that went into place, state and local property taxes were capped. The deductibility of them was capped at $10,000. Yes, there is talk of adjusting that. Senator Chuck Schumer of New York has identified that as a high priority item. He has not mentioned whether he wants to raise the cap or eliminate it entirely, but he has indicated it as a top legislative priority. Second question is, do you recommend variable annuities at this point because of the potential for higher taxes? Not yet. The key with variable annuities, that some things that you have to watch out for, they are very high fee, or some of them can be. You end up paying maybe 2.5%, 3%, and getting bells and whistles that you don't need to justify that cost. There are low-cost variable annuities that could be a good option. But for now, with only the top tax rate increasing and or potentially increasing, sorry, and dividends and capital gains still being treated favorably, I would not recommend a variable annuity. You would be basically converting tax-efficient brokerage assets into an account on which at some point you will pay ordinary income. So still doesn't work on paper for that. Next question, when might the estate tax exemption change? That's a great question. I did put it on the further right of the spectrum in terms of how big of an adjustment it would be. I know that we've seen a $3.5 million exemption before. However, in the 20 years that I've been doing this, the exemption amount has continued to increase. There hasn't really been a decrease unless you count that goofy one-off year where George Steinbrenner died and there was no estate tax. So, you take that plus the fact that it's not a major revenue enhancer. I would expect it to be one of the things that, if it even got adjusted, would not be this year. Would likely be next year if they do it. You'll be close to an election. So I think it's worth keeping an eye on and understanding some of these techniques and starting to think about them, because those level 2 and level 3 techniques were definitely things that do involve a loss of control over your assets and are bigger than just setting up wills and trusts. But keep an eye on it, and I wouldn't rush to give away assets. Great. So it looks like those 3 questions, which were awesome, are the questions that we have. Thank you for everyone for joining this webinar. And for next steps, we'll be emailing you all a short evaluation and would love to hear your feedback on how the webinar went. I'd be happy if you'd like to reach out through my email address, sazuz@heritagefinancial.net, to answer any questions that you have as well as go through a financial planning or a tax planning overview with it. I'd be happy to send you a copy of my book if you do not have that already. And I'd also encourage you to sign up at thebostonadvisor.com for my blog and just get updates on this topic, other topics related to personal finance, as well as future webinar invites. Thank you very much, everybody.